finance program. And today, our speaker, Mitchell Anderson, he'll be discussing financial trading and his experiences at Covenant Trust. And before we begin, I just want to encourage you all to prepare and ask questions in the Q&A tab on your screen. The chat will be disabled just during the presentation, so drop any questions you have in there. And if they're applicable to what's being talked about at the time of the presentation, I'll interject and make sure to get those answered. And if they're not as applicable, then we'll wait till a little more natural pause in the presentation to get those answered. So with that being said, take it away, Mr. Anderson.
Well, I'm grateful to be here. Can everybody hear me? I'm a portfolio manager. I live here in Chicago, Illinois. I've had a very interesting career. I've been in the industry for almost 10 years now. I look a lot younger than I actually am, so don't be fooled. I've had an interesting journey. So today I'd like to share a little bit about what I know about the industry. So when I was young, I had no idea what I wanted to do with my career, and I thought about it a lot. When I went to college, I went to Brigham Young University, Idaho, and I explored every subject out there. In fact, there for a while, I thought I wanted to be an attorney, and I was a history major. And I found out quickly that if I was a history major and didn't go to law school, I probably would end up selling life insurance. And nothing against life insurance salesmen. I just didn't think that was the career path for me. So, I started out in accounting, didn't really like that, went to history, and then I took an economics class, and then everything just came together. And I knew that this is what I wanted to do. And I knew this is where I was supposed to be. The most important thing for me in choosing my career was to find something that I enjoyed, because you are going to spend more time with your coworkers, unfortunately, sometimes than you will your family. And I knew this was something that I was going to be doing every day. So I really wanted to make sure that I enjoyed it. The thing that captured me about finance and about investments and about markets is that they're always changing every day. I go home, I check the futures. I wake up, I check the futures. I check Twitter. There's a couple of things that I check. And I love it because it's always changing, and it keeps me on my toes. It can be somewhat stressful at times, but I love it. And I think that's the number one thing. I don't really have prepared remarks. I'm just kind of speaking as I go, but I would say that's the number one thing. There's a certain breed of people out there that just love this stuff, and that's me. And if that's you, then I would encourage you to just go full on. If you're a Kobe Bryant, fan, Mamba mentality, just full on go for it. Because those are the people that succeed literally in this industry. If you're in it for the money, you might not last. You might not be very good. I don't know what it is, but there's just something about the intellectual curiosity, the intellectual stimulation, the challenge that it is to navigate markets that is just really exciting to me. So I wanted to break up my presentation into 3 parts. First of all, I'm going to go through career path. Given how much exploration I did, I flew out to New York 4 times on my own dime just to network with people. And it's frustrating because you go out there and you want to meet with them and they say, oh, okay, next time you're in New York, why don't you hit me up? And, we can talk next time. Like next time I'm in New York, I just spent $500 on an airplane ticket. How often am I going to get to New York to talk to people? But my first trip out there, I went with my school and I met some people and I got some traction. So people thought I interviewed well. And so I thought I wanted to be an investment banker. That sounded really fun, really sexy, if I can use that word. So I really wanted to try and be an investment banker. I wanted to put in the 100 hours and I wanted to really propel my career. So I went all out, and I went to Brigham Young University in Idaho. Brigham Young University in Utah has a decent network. BYU Idaho has no network. So I was up against a fat wall. So I feel like my path into the Wall Street and into this industry was very challenging. I was at a big disadvantage because nobody at my school had ever done investment banking before, and I wanted to be the first one. So I went all out. I flew out to New York 4 times. I flew out to Houston twice. Literally spent my life savings because I thought if I can just land one of these jobs, it'll pay for itself. And I ultimately failed. I ultimately didn't make it. And in hindsight, I'm really glad, because that wasn't really the route I wanted to take. I'm really interested in macro markets. I'm really interested in the moves of interest rates and oil and how that impacts asset allocations. So call it universe intervention. I don't know what you want to call it, but I feel like I ended up where I wanted to be. I kind of fought against the pricks for a while, and I wouldn't really recommend that route because that really wore me out, and I spent a lot of money. But what I would recommend is being aggressive. It's okay to be aggressive. And as far as for me, I would love to just give back, because I had so many people who are so kind. You'll find that when you're networking and you're doing, you can do your informational interviews, do your research. People are more than willing to help and to give back. That's how I feel. I'm so honored to have been asked to be able to speak with you guys. And I do feel like I have a good feel for the industry and for the different routes that I might be able to help people navigate and understand where their interests might be and where they might want to end up, how they can prepare. And then that'll be the first third. That'll be the first third of our presentation, and then I can take some questions after that. And then I'd like to go into a market deep dive. I'd like to give you guys, a formula, formulaic, lay of the land of where we are as far as markets are concerned, what we're doing with the Fed, what we're anticipating for the rest of the year, some risks that we're watching, and then we'll take some questions there. And then I thought I'd take you through my wheelhouse is portfolio management and investment management and creating portfolios. So I thought I'd take you through my wheelhouse on how to create a portfolio. And I know a lot of you guys are probably out there trading on Robinhood. I think that's great. I think it's great getting experience. But the number one thing is to develop a process, because I have made a lot of mistakes, and I would love to talk about mistakes. If you guys are like, hey, what are mistakes that you've made? What should I avoid? One of them is not having a process and just saying, hey, I like this stock, I'm going to buy it. It went down a lot, and then it goes down a lot more and a lot more, and then you get into this hole. And I've made those mistakes, and those mistakes will be made. It's part of the, it's part of the learning curve. And I also want to say, before I get into this, to not be intimidated. You guys are just as smart and just as capable as anybody out there. I remember going to my first investment committee meeting, so intimidated. So like, I thought everyone knows about stocks. I don't know anything about stocks. People seem to like know all this stuff. A couple of months later, I found out they don't really know anything. Same thing when I came into the industry. My second job, I was an investment analyst. And after a couple of weeks, my boss started putting me in front of macro strategists from like JP Morgan and Citi and Goldman Sachs, and wanted me to spar with them, he's going to come at me with what his views are, and he wants me to push back. And I had no clue. I don't know what's going on out there. I don't know what the market's presenting. I was super intimidated, but I found out very quickly, and that's what I want to reassure some people, is to not be intimidated and to just take it one step at a time. And there is a learning curve, but you will learn it. So I guess that's my motivational speech for now. And I guess I'll get into my presentation. So hopefully I can pick the right screen here. Share. Oh, that's my Bloomberg. Shoot, how do I get out of this? Stop. Share. This is the one I want. All right. Okay, so street smarts for everybody here. Career paths. That's the first thing we're going to hit. I don't know if you guys know this, but there's a buy side and then there's a sell side. Most people, so my path was not the conventional path like this. I'm a little bit of an entrepreneurial spirit. I'm a little bit of my own animal, so I went about it my own way. Again, I wouldn't really recommend the way I did it. It really wore me out. It ended up working out for me, but it's challenging. But basically, your typical path into Wall Street is, if you don't know what you want to do, that's okay, because you'll figure it out real quick. You'll get into your first job and you'll say, I like this, but I don't like this. And if you don't get the first job that you wanted, because I certainly didn't, I wanted to be an investment banker. I ended up not getting that. I ended up working in an operations trading group. It was my first job out of college. But, I worked really hard to kind of get out of that situation. I did not want to do operations for my whole career. So I was able to get out of that. So what I can say, if you wanted to work in private equity, Private equity are the people that go and acquire companies. They lever them up with debt. They use the cash flows from the company to pay down the debt, and then they sell it for a big multiple, like your KKRs, your Bain Capitals, your Blackstones. That's private equity. You can make a lot of money there. That's where a lot of money is made. In order to get into private equity, you need to use two routes. You can go the investment banking route. So out of school or out of an MBA program, you can go work in an MBA, an investment banking division where you're going to be doing a lot of M&A deals. You're going to be pitching like, hey, this entrepreneur wants to sell his company. Are you interested in buying it? And you try to tie together the deals. You get a lot of modeling experience. You get a lot of experience about your specific industry and the specific sector that you're involved in. And that builds some of your skills, your knowledge base of the industry, and some of your quantitative modeling skills to help you be a private equity professional. So that's one route someone could take. I will say it's very difficult. You most likely need to be at a top school or a top business school in order to get in. Sales and trading, that's another route you can take. Trading has totally changed. I work actually in the Chicago Board of Trade building here in Chicago. It's like the Batman building. I work here, and this is where all commodities were traded from 1900 up until basically 2010, when everything started going electronic. So sales and trading has adjusted a little bit, especially on the equity and especially on the commodity side. But you still need bond traders. You still need FX traders, but everything's going electronic. So if you really want to get into the sales and the trading, if you want to be a market maker is what they're called, when people like me say, hey, I want to buy this stock, or hey, I want to buy this interest rate swap, or I want to buy this derivative, put it in order. There's a market maker behind the scene that puts the buys and the sells together. That's what sales and trading is. Usually people will do that for 1 or 2 years, and then they'll go over to the asset management industry, or they might go work for a hedge fund. The route that I'm on, you can go work, in a sell side research role. Some of the people who are pretty smart, you can go work, in a sector like tech or industrials or energy or consumer staples or consumer discretionary, and you can be a specific sell side analyst that just researches companies. You could do it at Morningstar, Morgan Stanley, Goldman Sachs, any and all the banks. There's a lot of boutique banks you could do it at as well. Usually people who work on the sell side for 1 or 2 years, they develop, a specific skill set. And if they're good enough, they'll get picked up by someone on the buy side, where you can work, you can work at a firm like mine. You could work at a trust company as an equity analyst. You could work for a mutual fund. You could work for a hedge fund. There's lots of opportunities for you in research. If you want to be an investment advisor, I think the best route for you to take would be to find some investment advisor out there. There's lots of them. They're at Merrill Lynch. They're at Wells Fargo. They're at BNY Mellon. They're at Bank of America. They're all over the place. If you want to go be one of their right-hand men, to be a private wealth associate and help them with client presentations, help them do their financial planning with clients, eventually you can probably inherit a book of business and become a financial advisor. I probably think that's probably the easiest route to take. Other than operations, you could always go work in operations. If you're kind of like a behind the scenes guy, you're not really into meeting a lot of people, you just kind of want to go to work, do your thing, go home, you can work in operations. That's where I started. You do a lot of trade settling, you do a lot of middle office work, and supporting advisors. You execute trades and you input trades, but it's not like a market maker who's buying and selling. You just type in to the trade into the system, and then the market makers do it for you. And that path would probably lead you to be an operations manager. So I hope that gives people somewhat of an overview of some of the jobs in the industry, and really the perfect route to get there would be to start somewhere here on the sell side. Maybe you have to go to business school, or maybe you meet some connections that you can get over to the buy side. Most people want to be on the buy side. Oh, do I got to scroll down here? Let's see how this works. Career advancement, I definitely would recommend a bachelor's degree. I have a bachelor's degree. I do not have a graduate degree, but I am working towards a certification. I'm working towards the CFA, the Chartered Financial Analyst exam, which is pretty hard and takes a long time to get. Usually takes about 3 or 4 years. And because of COVID, 5, because I wasn't able to take the test, the last year. I just passed level 2, which is the hardest one. So, congratulations to me. I did it. It's really hard, and I'm really glad that I got that over with. But you don't have to have a bachelor's degree. If you want to be on the lower end of financial planning and advisory, you can work at a bank and you can get some of these series licenses down here at the bottom. If you want to get your Series 7, your 63, your 65, you actually don't need to go to college. You don't need to be to have a bachelor's degree if you don't want to. You could get your series licenses, but you're not going to be working with the higher clients. You're going to be working with the lower ones. So you just got to know that. I do think if you really want to work kind of in the best parts of the industry, I would recommend a graduate degree or a specific certification. You don't need both. You can do one or the other. The MBA is really for investment banking and private equity or management consulting, which is not necessarily finance. But if you want to do investment banking, if you want to do private equity, if you want to do management consulting, you're going to need an MBA. Just know that you're going to need to get the best MBA that you can. If you want to do something like I'm doing, I'm a portfolio manager. All I do all day is do research and put together portfolios. I do some trading. The trading that I do is kind of massaging my portfolio, bringing things up to the top, bringing things down to the bottom, getting rid of stuff. But I do it actually probably more than the average. But if you want to do something like that, the CFA is a certification that you're going to want to pursue. I will say it's probably the gold standard. It's probably the hardest one relative to some of the alphabet soups that are out there. Some people like to have the CIAI, CIMA. I don't even know what those mean, but it's fine if you want to get those, but I don't know what those mean. But I know if someone has a CFA, you get a lot of respect. It's really hard. It's a hard test. So that's the route I'm on. If anyone has, interest or questions about that, I can definitely, that's my specialty. If you want to be a wealth advisor, I'd recommend the CFP, the Certified Financial Planning certification. It's not quite as, difficult. It's not quite as long. It's just the thing about the CFAs, it just takes 3 to 4 years to get. It just is grueling. It just takes forever. The CFP you can get in about 18 months. So it's just like a little bit quicker. So that's if you want to be a wealth advisor. There's a difference between what I do in doing the research and putting the portfolios together and a wealth advisor that does all the financial planning. And then, hey, if you want to, my brother's in accounting. I don't know much about it. The way I see accounting versus finance is accounting is in the past. They're looking at past statements and making sure they're accurate versus finance is like looking forward and preparing for the future. So, accounting's backwards looking. Finance is more forward looking. But if you wanted to be an auditor to go into these companies and make sure all their statements are right, you can get your CPA and you can do accounting. So that's kind of the, some of the career advancement options you can take. I already kind of mentioned my career path. I went to a non-target school. I went to BYU, Idaho. Some of you have probably heard about BYU, and it's a great school. BYU, Idaho is a sister school. BYU has a great network. They place people in like investment banking and stuff. BYU, Idaho, not at all. It's very much a new school. I went there just because I did both, actually. I went to Provo and the Idaho school, and I just had more friends in Idaho, so I went there. And then I fell in love with their financial economics program, and I thought, well, the trade-off for doing this specific major that I want to do is I'm just going to network really hard and see if I can break into the industry, which worked for me. It was a lot of work and there was a lot of failure, but ultimately I'm here and I'm very happy about that. But like I said, I explored many different subjects. I switched my major officially 3 times, but I hustled. I was a hustler. I was hungry, and I'll take a B student who's hungry over a perfect A student any day. If someone's got passion and they love it, then that's what you really want in like a worker. So I networked in New York. I did tons of informational interviews. I flew out to New York and Houston trying to meet people, trying to make it, and it ultimately didn't work for me. I was able to land a couple of internships while I was in school, so I would recommend as early as possible trying to line up any internships that you can. I actually ended up doing one internship after I graduated. That wasn't a great fit, so I traveled the world for a little while, ran out of money, decided to be a temp at Goldman Sachs in Salt Lake City. Didn't like my situation and being a temporary worker. So I had an opportunity come to me from an investment bank called William Blair, and they're in Chicago. They're kind of the premier investment bank here in Chicago. And I started in the operations in the back office. So this is kind of an interesting story because I started in the back. I moved to the middle office, and now I'm in more of a client-facing front office role. That's not always the case. You can get stuck. in the middle office. That's true. But if you pursue some of the certifications, I think my pursuing of the CFA helped me kind of break away into a front office role. If you want to be in operations, I've met a lot of great people there. There's no problem with that. I just love the markets. I love them. So I just wanted to be a part of market action. So I started my career on the stock loan desk. I would borrow stocks and bonds for short sell transactions for our traders who worked upstairs. So that was kind of fun. I did that for 3.5, almost 4 years. I got married and my wife did some schooling in Pittsburgh. So we moved out there where I was an investment analyst for 3 years, analyzing stocks, analyzing ETFs, mutual funds, did a lot of macro research until we moved back to Chicago and I became a portfolio manager here at Covenant Trust. So here at Covenant Trust, I have a lot of autonomy to manage the portfolios that our clients are invested in. So that's my career path. If I had any advice for any of you guys, grades. If you're in college, grades are so important. Grades trump your major. Like if you, obviously there's easy majors. There's communicate. Like if you have a 4.0 in communications versus a 3.0 in mechanical engineering. Obviously mechanical engineering is a lot harder of a major, but I would say, your employer will train you. And if you get good grades, that proves that they can teach you. So just really try your best. I know it's hard. I know college is super hard, but really, if you can get good grades and have a high GPA, then you can almost write your ticket. And even on Wall Street, if you study history, people like that. They like people who have unique backgrounds and interests. They do, because you can bring a whole world of analytics to a team that is not a typical finance bro, right? Like a typical finance major. So I would really encourage you to search out and find something you love and something that's going to get you good grades, and that'll help you more than actually majoring in accounting. But some specific careers you're going to need to major in accounting because it's going to help you pass the CFA. But that's my advice there. Any other skills? Like if I was to hire somebody, I'd love someone who knew a little bit about VBA or Excel. That's an obvious. The world's moving more towards quantitative coding and everything. I don't know how to code. I've thought about learning just because it would help my career. But you don't have to. I've made it this far in my career with not coding. But it's definitely a value add. Like if you know how to, if I had an intern or if I had an analyst who could code, I've got so many ideas that I think work in the market, but I don't have any statistical mathematical evidence that they work. So it'd be nice if I had a coder who could kind of run those things for me. And I actually would say the most important thing is just someone who has passion, someone who shows interest, and someone who's somewhat well read. If you're hungry, you will make it. You will learn. You don't need to be an A student. If you're an A student, all the power to you. If you're a C student, but you're hungry and you work hard, you can make it. And so I will hire the passionate C average student more than I would hire an A student, to be honest. And that's not the case always. That's just me. I just love someone who has a strong passion because I feel like that fits who I am. I was a good student. I had good grades, but I had passion, and I feel like that's my competitive advantage against my peers, and it's worked off. I've been in the industry for 10 years, and I've worked my butt off. Well read. I've read a lot of books, and I have really made a big commitment to my knowledge, and that's helping me now as I work with some of my coworkers and peers, where I know a little bit more things than they do, and that's good. That can help your career. So this is the last slide for this section, for kind of the career development section. I wanted to pause on it though, because to me, this is the most important slide that I could provide you guys, because knowledge is just so important. One of my first mentors I met, he was in New York. He's kind of a smart guy. He went to Harvard Business School and he was a Baker Scholar. So he was in the top 5% of his class, just a really smart guy. And he asked me, how many books do you read? And I said, I read maybe a book a month. And he said, I read 1 or 2 books a week. If you want to make it in this industry, that's the kind of commitment you have to your education. So after he said that, I just started reading like crazy. And these are all the books that I've read. And, I'd like to take some questions if there are some. If there aren't, that's fine. But if anyone wants to take a screenshot, or if anyone wants to write some of these down, or whoever's leading this organization wants to get this slide in front of your hands, I've divided them up into a couple of different categories. So if you're a stock picker, if you want to learn how to pick stocks, these are some of the books that I've read that I would recommend, that my mentors recommended to me. They'll give you, the bare bones on how to pick stocks. I fall more into the camp of quant risk management and macroeconomics. That's kind of my thing. I love macroeconomics, and the world's moving more toward the quant world. So that's kind of where I focus my attention. The Misbehavior of Markets is by far the best book in finance I've ever read. It's pretty dense. I've read it a couple times and I still don't understand everything, but it's the best one. So yeah, I don't know if there's any questions even about any of these books. I mean, if you're interested in trading, Michael Lewis has written a bunch on trading that are kind of fun. The best guy in macro is definitely Ray Dalio. Anything that he writes about macro is he is the best when it comes to macro analysis. So I made this list for you guys, and I hope some of you guys might actually read some of these books, depending on what you're interested in, because this has been probably the biggest value to my education and my career, honestly, is just reading. And I feel like it has put me ahead of my peers. To be honest, I do. I feel like I'm ahead of my peers because I've committed myself. I try to read a book, twice a month. That's my goal. I keep doing it, because I met this guy who always reads. So I'm always reading. So I think it's very important. I don't think people realize that, especially for my industry and investment management, portfolio management, we read a lot. So if that's not your thing, maybe you want to be, a wealth advisor, because they're kind of the partiers. They're kind of the ones who take people golfing and take them to concerts. And, it's kind of a sales job. It's kind of a fun job. But if you really like the markets like me, you'll probably be doing a lot of reading. And I don't mind it because I'm interested. So just wanted to pause on this slide. Are there any questions, Colin?
Yeah, there is one question that someone has in the chat, and it's,
Okay.
what is the most important lesson you have learned from a failure?
From a failure, never make the same mistake twice. Everyone's going to make mistakes. It's inevitable when you're starting out in your career. I know how it is. I was super anxious. I had a lot of anxiety with my first job. And it's okay to make mistakes. Your boss will be fine with it. He expects it, to be honest. He expects you to make mistakes. Just really try not to make the same mistake twice. Now, when it comes to portfolio management, I can tell you the two mistakes that I have made. One is trying to focus too much on this and what I think is going to happen versus what my quantitative models are telling me what's going to happen. I've made a few mistakes trying to overpower my quant models because I trust the math more than I trust this, because there's so much going on in the market that I feel like I trust the math more than I trust myself. So I've made a couple of small mistakes trying to trump my quant signals and try and trust my narrative. That's kind of a side issue to the one mistake that everyone makes is don't get too big in a single position. You got to have rules. So my rules are, on an equity, I never get over 6% in a single position on an equity in my portfolio. I don't care what it is. I don't care if it's going to 10 times. I never get over 6%. It's just a rule, because that's a mistake. I made this mistake in February. I got really into this stock. It was slightly illiquid, and then when Jerome Powell came out a little hawkish, and liquidity dried up, my stock just and it really hurt my portfolio. So that's a mistake. I punch myself in the face, and not in my face, but I just get frustrated with myself because I've made that mistake before. But that's a big one. Just don't get too big in something. Have rules. If you want to take my rules, they work for me. No more than 6% in an equity, no more than 10% in a bond. I don't care if it's an ETF bond or whatever. No more than 4% in a commodity, and no more than 12% in a currency. I'm a macro investor, so I don't just invest in stocks. I invest in anything. Bitcoin. I invest in Bitcoin. Bitcoin to me is a commodity, so I will never have Bitcoin or Ethereum more than 4% in my portfolio. So that's something I feel strongly about. Just when you're trading, and I'm going to show you, later in the presentation how to construct a portfolio. It's not about buying and selling and day trading and technical analysis. We can talk about that. I think it's totally bogus, because it honestly is. But it's just really all about the portfolio, and just not getting too big in something is definitely the biggest mistake that I've made. That's a good question, by the way.
And we got one more, or I guess another one too. So Uh, Aside from books, are there any virtual links to study or read regarding investment and finance portfolios?
Yeah, so I've shared this with Colin. I think I'm not a big podcast guy. If you are Macro Voices, that's one podcast that a lot of people like. I believe in certain research providers. I do not like research from banks like Vanguard or Citi or Goldman. I don't trust them because they have a conflict of interest of trying to get me to buy something. And if it's free research, that means it's not very good. So I follow a firm called 42 Macro. I think it's easily the best research and the most affordable research on Wall Street. Easily. It's like you could pay $50 a month for one of his products and you would just learn a lot. So I know you guys are probably in college and have budgets, but on Twitter, you can get on Twitter and follow a guy named Darius Dale or 42 Macro. 42 Macro is my favorite research provider. Hedgeye is pretty good. They do a pretty good job of providing independent research. Um, yeah, I don't know. I hope that answers some of the questions. I'm not a big podcast guy, but Macro Voices I know a lot of people pay attention to. I mean I'm getting kind of like deep in the weeds. This is like deep research for like really advanced people. I think follow if you're just starting out, I would definitely follow Bloomberg. I don't like CNBC, but Bloomberg's okay. I would follow Bloomberg and start following the S&P 500. Start trying to pick up on what the drivers are and what moves the markets and why is the Nasdaq up and why is the Russell 2000 getting slaughtered? And then 2 days ago and then today, why is the Russell 2000 way up and the Nasdaq's getting slaughtered? You can see that on your screen, and then sometimes the news providers can provide some insight on why that's happening. That's all I did. I just want to let you guys know I was super intimidated by finance, and I just started following the S&P 500. I just started following it on my phone and watching it go up and down and trying to figure out why did it go up today? Why did it go down? And I think that's a fine place to start.
Yeah. And then we got one more question and then we'll move on in the
Okay.
presentation. So this last one is, what would you recommend to a sophomore in college from a non-target school for breaking into asset/investment management as an analyst? What made
Yeah.
you know for sure that this is the right field for you?
I took an investment class and I just loved it, and it clicked and it made sense. The thing that really convinced me is I knew I would wake up every day and something would be different, and I knew that would motivate me. That would keep me interested in my career. I don't want to be bored. I do this for 12 hours a day or more or less, but it consumes my life. And I just wanted to make sure that I enjoyed it. And I enjoyed the fact that markets are always changing and they're never the same and you have to keep on your toes. So my advice to you as a sophomore would be to reach out to alumni and just do informational interviews and really try to line up as you can never start too early on internships. Try to get an internship this summer or this fall. If you have to offer to do it for free, offer to do it for free. Just try and get something on that resume. Get something, get something if you can. If you can't, then I understand how hard and competitive it is. But yeah, for a sophomore, when I was a sophomore, I did my first internship, and then I did another internship as a junior. And like I said, I was at a non-target school too, so I was kind of scrapping for any internship I could get. And they didn't really lead to jobs, you know what I mean? But they got things on my resume, and so they got me interviews after when I was approaching graduation, because I had some of those things on my resume. So I feel you, man or woman, whoever asked that question. I know it can be stressful, and you want to really get out there and succeed and do it. But I would recommend trying to nail an internship as soon as you can. If you don't do it, don't worry, don't fret. You got next year. Start networking. I'll tell you how the Wall Street cycle works. You need to start looking for an internship for the next summer in September, honestly, because you need to start getting on recruiters' radars in like September, October. I don't know if any of your schools have like trips you can take, or just try and connect with alumni or anybody in the fall, because they do all of their internship recruiting in the winter. So like December, January, they start doing the interviews. So that's when you want to get an offer in January. If you can get an offer in January for your summer internship, you're golden. But I mean, if it doesn't work out, just have no fear. It didn't work out for me. I was one of those who, just felt like I was a failure many times. But I just kept grinding, kept going, and I knew eventually, as long as I stayed up on my books and my knowledge, and as long as I started passing my tests, like my series exams. After my first job, I passed the Series 7 within 6 weeks because I wanted my boss to know I was smart, and I was a go-getter. So I would recommend passing those exams quickly too once you can. Move on now.
We got one more, I guess we can answer really quick. And then, yeah, we should move on. So any recommendations for people who graduated 5 years ago with an economics degree and are looking to go into your field?
Yeah, I would start pursuing some of those certifications. You can get in with the CFA or some of the series licenses or the CFP. Yeah, if you're not already, if you are, you just got to network and do the best you can with networking. But those certifications do help. The fact that I have some of the series licenses under my belt, and now that I have level 2 done with the CFA, that stuff helps. So just keep building your education, and getting those certifications is probably what I'd say. Moving on now.
Yep.
Okay, I thought I'd take you guys through a quick market update. I don't know how much time I'll spend here. We're at an interesting point in markets where stock market's at an all-time high. The Fed is providing more liquidity than they ever have before. So when you think about economic cycles, the minute stimulus enters the economy is the minute that a new business cycle starts. So the fact that the Fed is so easy and putting so much liquidity in the market, that tells us that we're early cycle. But even in between the early cycle all the way to the next recession where jobless claims and unemployment goes through the roof, there's going to be these intermediate cycles. So while we're early cycle, we're kind of peaking in the first intermediate cycle. We're going to get one or two of those. So, here, I don't want to get too into the weeds. You guys can read this stuff if you want. This is an interesting graph I like to put together. It shows the valuation between stocks and bonds, and when you want to get aggressive with stocks and when you want to get aggressive with bonds. And I think it's interesting that and this is basically your earnings yield on the S&P 500 minus the 10-year rate of a government bond. And despite rates being really low, the valuations in stocks are so high that bonds actually don't look that unattractive right now. And you've seen that if you follow, the 10-year rate has dropped from 1.75 all the way to 1.25. So bonds have actually outperformed like small cap stocks over the last couple of months. Earnings growth have totally surprised to the upside. Most companies have totally just slaughtered earnings expectations. If you've missed, you've been absolutely punished, though. I don't know if you've seen some of the stocks lately, like Etsy or Uber, but then they rebounded really fast, or Roku. Some of these stocks that reported this week just had awful expectations. I guess I'll point out this slide right here. This is the biggest risk that I see in the macro world today. This red line represents the reserve requirement in China, how much the Chinese government requires banks to keep on reserve. And you can see that usually follows the Chinese yuan, but that's decoupled over the last 2 years. And if the Chinese decide to devalue their currency, that's going to put a lot of upward pressure on the US dollar, and that's going to be a deflationary environment, which is going to put a lot of downward pressure on US assets. So if you care, this is the biggest risk I see in the macro world, that the Chinese decide to aggressively devalue their dollar. This is just equity valuations. Everybody knows valuations are at all-time highs. This is the 2000 tech bubble when we had high valuations. You can see right now, we also have the exact same high valuations. This white line represents the S&P 500. This blue line represents international, like Europe and Japan. And this orange line represents emerging markets. So these are not going to change very much. The U.S. markets are usually always going to have higher valuations than overseas because overseas is a little more risky. So when there's more risk, you have lower PEs. And you don't always want to buy low PEs. This is something people always think you want to buy a low PE stock. That's not always the case. And I think that is definitely evidenced here. It's kind of blurry, but this blue line represents, I don't want to get too much into what a z-score is. Maybe there's some math whizzes out there and you'll like this, but this blue line represents basically the percentile ranking of valuations over the last year. And whenever United States, for the blue line, United States valuations have been in this range before, the 1 year forward return for the US market has only been 1.68%. So you can see that there's not a lot of upside left in PE expansion in the market versus the world, which has lower valuations, but they also have lower expected returns over the next year. So just because a PE ratio is lower than a high PE ratio, that does not make it a better investment, because sometimes things are cheap for a reason. These higher valuation stocks, they're higher quality, they're growing more. So it's just not like, oh, I go out and buy, cheap PE stocks, because cheap can always get cheaper. There's a lesson that I've learned that maybe I can pass on to you. I'm going to go through these pretty quick. GDP is peaking, it's inflecting high, and then it's slowing down. That's a fact. That's happening. Inflation is not so certain. We had the highest number reported at 5.4%, highest number since December of 1990. You can see that here at the secular view of inflation. If this number, this is the thing, if this number continues to come in hot in the 5 handle, you will see a correction in the equity markets, because if inflation really is not as transitory as Jerome Powell continues to tell us, and inflation continues to go up, that's going to pull forward Fed expectations to tighten monetary policy. And every time that the Fed tapers and stops doing their liquidity asset purchases into a cyclical slowdown, which is where we're headed, right? You can see GDP is inflecting lower. You can see inflation is inflecting lower. Every time that happens, you get a 20% correction in the S&P 500. So that's what I'm watching. That's what everyone's watching. The minute Jerome Powell pushes the button and says, we're pulling back, you could get a decent correction in the equity markets. I wanted to show this cyclical view, though, because while inflation is high and is somewhat transitory because of all the disruptions from COVID-19, you can see that the forecast that we have here from 42 Macro, I use 42 Macro. I haven't built mine out yet. I just got this job, and he's the best that I know. You can still see that we're expecting over the next year, June 2022, for inflation to still have a 4 handle on it. Like, we're still expecting 3 to 4% inflation, which is much higher than we've experienced over the last decade. So my personal view, is that inflation is somewhat transitory. I do think it'll level off, it'll inflect lower, but I do think that it stays higher than the Fed anticipates. I do think it's going to be a little more sticky. If you think about it, even from an anecdotal perspective, if people raise prices on something, or if they raise wages, are they going to lower them later? No. Like at the grocery store, if they raise prices, are they going to lower them? If they give you a raise, are they going to lower them? No. So, that's an anecdotal evidence, but some more empirical evidence you can see here. This white line represents home prices. So the fact that the Fed, and if you get my bias, I'm not the biggest Fed fan, but the fact that the Fed is buying all these mortgage purchases, they're keeping interest rates low in the mortgage market, that is ballooning the home prices. Home prices are out of control. They are just as high as the housing bubble of 2007 and 2008. You can see that here. And usually rent, so I still rent, unfortunately, and a lot of you probably rent. Over the next 18 months, you can definitely expect your rents to go up, which will keep inflation into the 3 and 4%, is my expectation. So I do expect inflation to be higher than the Fed thinks. Unemployment, I'll hit on this really quick because I want to get to some other things. As long as, we had a pretty good jobs report today, but as long as inflation or unemployment stays above 5%, there's no way the Fed's going to taper. But once you start seeing unemployment getting the 4 to the 3% handle, you could see a pullback in asset purchases, which I expect when the Fed does that, you get a correction in the equity markets. It's just going to happen. Okay, so PMIs in the business cycle. Something I wanted to teach you guys here is, I talked about how you can know where you're at in the business cycle given where the Fed's at. And they're really easy and they're really providing a lot of liquidity, your early cycle. And then when you have a recession with jobless claims going through the roof, you're at the end of the cycle. But in between, you have your intermediate cycles. And manufacturing PMIs and service PMIs are the best indicator to tell you where you're at exactly in the business cycle. You'll hear people say it's hard to know where you're at in the business cycle. Well, that's not true. I know exactly where we are in the business cycle. I know that the Fed is easy, so we're early, but we're also hitting an intermediate peak here with manufacturing PMIs are peaking and rolling over. Services PMI still peaking, ironically, but I expect that also soon to start to roll over. Once that starts to roll over, your earnings growth in your companies are going to start to roll over. You could see some disappointments in the back half of the year. GDP will probably come in lighter than expected. And if you get some of those disappointments, the bond market's going to love that. Interest rates will go lower and you could see a more volatile or choppy. I expect more volatility in the back half of the year, just given where we're heading into a cyclical slowdown, which sets us up for disappointments in economic data, company specific data. So I'm a little bearish just because I think we're inflecting lower and I expect the Fed to tighten into that. And that's just my view. I could totally be wrong, but that's my view. I'm not going to spend time here on rates. I'm not going to spend really much time here either, other than I have a fun little study that I do. I look at month over month Sharpe ratios, and that basically tells me what the market is buying and what the market is selling. So if you were like running a long short fund, you want to be long these things over here. This is what the market is buying: utilities, healthcare, Bitcoin, tips, Ethereum, minimum volatility, quality, low volatility, defense. You can see that the market is anticipating a slowdown. Obviously, they're buying these defensive assets. They're not buying financials. They're not buying small caps. In fact, they're selling them. The Russell 2000 value, they're selling these things. They're selling high yield. They're selling, emerging markets in China. China's been blown up basically over the last couple of weeks. So, this tells me you want to own the things over here because this is what the market's buying. You don't want to own the things over here. This is where you want to buy your calls. This is where you want to buy your puts, basically. So that I don't want to, take up all of our time because I do want to show you one more thing, but that's my market outlook. If anyone wanted to know, are there any questions that we can go through real quick?
Yeah, we did have one question during that, and it's, do you think the Delta variant of COVID can create another market crash?
I don't. I think I could be wrong. But it's already known. So here's the thing, and this will get into my next segment. We were already slowing and headed towards a recession before COVID hit. Okay, PMIs were low 50s. Unemployment was, all-time low. That's great. But the economy was slowing, okay? And growth and inflation were slowing at the same time. So things were starting to get a little choppy. And then when COVID hit, it was just like a hammer on a nail. It just kind of blew everything up. And COVID took everything by surprise. So the market was going to slow anyways. The market was going to be choppy and slow. COVID just, made it worse. It turned a potential 5 to 10% correction into a 30% correction. So the Delta variant, I think it's more hype. I think I'm not a virologist, but from the ones I follow, I believe the virus becomes more contagious as it tries to stay alive, but it's also less potent. So I believe it'll kill less people, but it's something that the market already knows. Crashes happen when the market is taken by surprise and they're not prepared for it. The market is prepared for it right now. You can see that what they're buying. They're buying utilities, they're buying minimum volatility, they're buying defense. The market is more prepared right now than when they owned value stocks at the beginning of 2020. And I can show you some other metrics if you care. There's a put premiums, like if you're going to buy puts, they're bid up pretty good. Their volatility premiums are pretty high. So a crash doesn't happen when everyone's prepared for it, and a lot of people are prepared for it. So I'm pretty bullish right now. I'm risk on just because there's so much fear already baked into the market prices There's not going to be a crash when everyone's prepared for it. It's when nobody's prepared for it that it happens. So I could be wrong, but no, I don't expect. I mean, maybe a 3 to 5, maybe a 10% correction from Delta variant. Maybe. I think the Fed tapering into a slowdown is a much worse risk than the Delta variant.
Right. And we have a more international market question, and it's just, is the Chinese and Indian market overvalued? It's...
Oh, that's a good question. I'm going to say I'm not sure. Just because I'm not a big valuation guy. Valuations matter over the long term, over like a 3 to a 5 or a 10-year time horizon. My investment approach is I manage risk a lot differently. I'm more active in my portfolio in managing risk than I am too concerned about valuations. So I don't think so. I don't think they're overvalued. I think you could make the case that the United States is more overvalued than China, especially with the sell-off that they've recently had. I will say this, I'm not very bullish on China. I haven't been for a decade. Emerging markets have, sorry for my language, they've just sucked for the last 10 years. The whole street's been like bullish on China and emerging markets, and they've just been wrong. And I think they'll continue to be wrong. I don't know if there's anyone in this, in this conversation who's a professional, and they'll probably think I'm crazy, but I just think China's slowing on a rate of change basis. They've got a lot of debt. They got a lot of problems. We've got a shortage of dollars in the world. The world is just not growing very fast economically. And you've got a lot of companies in the United States that are still growing at 15 to 20%. And I think US companies will continue, this trend will continue, that they outperform China. That's just my view. I own puts on emerging markets actually right now because I'm pretty bearish on China, given that they're in a slowdown. I did that before all the regulatory stuff. Anyway.
And then we got one last one, and
okay.
It's, you mentioned shorting stocks earlier, so can you explain a little on how the extreme naked shorting in stocks, such as GameStop and AMC, can affect the markets, and how do you think this can affect prices for those stocks?
Yeah, I mean, that was crazy. I was actually really upset at Robinhood for shutting that down because I was part of that. I owned GameStop. I didn't even know that there was this Wall Street bet things out there. I have another analyst I follow that convinced me to buy GameStop. I bought it at 17, a call option. I sold it at 40. So I left I left a lot of money on the table. And AMC I've traded. I haven't been in it lately. But what happens is when positions get overcrowded, when too many people are in a position like a short, and there's not enough shares to cover those shorts, it takes a long time to cover them. It can cause a lot of pain. I mean, what happened is, like, obviously, GameStop and AMC are kind of garbage companies. They're companies that potentially could go out of business. I think that, investors have saved them, given their stock valuations are really high, so they can sell equity whenever they want. But the problem is with Wall Street is they were shorting junk companies, but we were at a point in the cycle when we were hitting a bottom and about to reaccelerate, when all the junk companies were going to have their, PE multiples and everything totally expand. And they were just caught off guard. They were just on the wrong part of the trade. So that's why I'm not so valuation focused, because valuations can take years, literally years, to work themselves out. Like, valuations matter 2 years out. Inside 2 years, the most important things are fund flows and policy and where we're at in the macro cycle. So from a macro perspective and from a Fed perspective, we were just in a big, huge reflationary trade, and they were too short. Everyone was short these things, and it just caused a lot of pain for them in the market. If you want to know about short selling, naked short, that's dumb. If your shorts don't go up or down, you win, because you always, so if you're short, say you're short Netflix, but you're long Disney, okay? You're going to take a 6% position in Disney, and you're going to short 3% of Netflix, and you're going to take that cash from that short, and you're going to extend your long in Disney. That is the purpose of short selling. It's to hedge yourself and to extend your leverage. I would never naked short something. I would never buy naked puts. You always do it to hedge yourself and to extend your leverage. So I don't know if that helps answer that question, because I do pairs trading. I do go long short sometimes. It not for clients, but for my own self, and that's how you do it. That's how a pro does it. Yeah, like if Netflix doesn't go anywhere, if it just stays flat, but my Disney goes way up, then and I'm levered, then I'm a winner. You don't always need your shorts to go down. If they're flat, you win. If that makes sense.
And that's all the questions we have for that section. So I think we can kind of move on to the last part.
Yeah, I wanted to take you guys through how I construct a portfolio. So I know we're running out of time. I'm going to take 10 minutes and that's my wheelhouse, investment management, portfolio management. I wanted to show you how I construct a portfolio. So this is one of my portfolios right now. This is how it looks. This is what I own: real estate, Minvol, gold, which I totally got killed on today. This is my portfolio. Okay. So when I construct a portfolio, I want to know from a top-down perspective, where am I at in the cycle? One, I know the Fed's super easy, and this is the matrix that I use to help me know where I'm at in the cycle. So if you,
there's only the screen isn't matching, I don't think. What?
Oh, really?
Yeah. I just see like investment management and.
How do I do this?
Let's see. Because it worked when you just scrolled earlier, right?
This is what I'm sharing. So I'm going to stop sharing this. And then share screen. Share this. Share. You can see my spreadsheet now?
There we go. Yep. Now we got it.
So when I construct a portfolio, I want to know where am I at in the business cycle, and I use this XY axis. And I told Colin this before when he came out to visit Chicago, that like y equals mx plus b, that little formula you learned in like 10th grade, literally my whole portfolio is based off that formula. Like that stuff is real. Like you use that in the real world. I use it every day. This is your x-axis. This is your y-axis. This is where, so there's 4 different quadrants. This first quadrant is a great quadrant for stocks. Everyone's a genius over here. This is when growth, GDP growth, is accelerating and inflation is decelerating. This quadrant is called reflation. This is where we've been for about a year. This represents when growth is accelerating and inflation is also accelerating. So that's why commodities have done awesome. Small caps have done awesome. And you can see this is where we've been from November 2020 all the way to right about now. So, the fact that you could buy anything you wanted over the last like 9 months and it's gone up, it's because this is where we are in the economic cycle. Everything goes great in these 2 quadrants. Where everything really goes wrong is down here. So this is the quadrant 3. This is where growth is decelerating and inflation is accelerating. And this is the worst quadrant of them all, when growth and inflation are both decelerating at the same time. I got this framework from, 42 Macro does a really good job of modeling it out for me. They do a lot of the legwork, but I learned all this from Ray Dalio. If you guys know who Ray Dalio is, if you don't, if you want to get to know him, he wrote a book called Principles. He's the best macro mind that I know. I love him. I don't like his principle stuff. He's out coaching celebrities. I think that's ridiculous. I'm not a big fan of that. But for his macro mind is top notch. And he discovered in the 70s that certain asset prices respond to the rate of change. So this is getting back into your math classes. Like calculus literally is the center of the universe. So your first derivative, or your rate of change in growth and inflation, that's going to change certain asset classes. So right now we're in kind of this reflation, but this is where we're moving. We're moving through, what's called Goldilocks down here into deflation. And these are my conditional probabilities over here. So you can see that I have a current probability of being 24% of being in Goldilocks. I only have a 9% chance of being in reflation because we're getting out of there. I have a 33% chance of being in inflation and a 33% chance of being in deflation. And that's what this graph represents. You can see that deflation and inflation, which are not good for risk assets, have been slowly creeping up here over the last 3 months. So what I do is I come up here to my framework here, and this would be Goldilocks, and say, well, right now I'm in deflation. So when I move this D down to deflation, these move down here. So my best asset classes are going to be fixed income and currencies. My worst are going to be commodities, equity, and credit. My equities, I want to own consumer staples, utilities, REITs, healthcare, etc. And as I change this, these will all change. If I go to inflation, boom, you get changes there. If I change this, boom, you get changes there. If you want to see a high level, these are the more general and these are the more specific asset classes. This is my asset allocation framework, remember? These are the asset classes that you want to own depending on what quadrant that you're in. So this is how I understand my asset allocation. So these are the things that I want to own right now. I want to own deflation. So, because that's the macro regime that we're currently in, we're tied between deflation and inflation. So maybe here I'll say we're in deflation. Over here on the macro regime, I'll say we're in inflation just to kind of even it out. Right here we're in inflation. But projected over here in my conditional probabilities out here into March 2022, we're probably going to be in this inflationary environment for the rest of the year. So I'm a little bit bearish on asset prices because of that. But over here into March and into April, we have a glimmer of hope where we might get up here into Goldilocks. So the next macro regime is probably Goldilocks. And that gives me my target beta. This is how I want to be positioned right now, given the current market environment. If you don't know what beta is, you'll learn in school. It basically tells you how correlated you are to the rest of the market. So the lower beta you are, the more defensive you are, the more higher beta you are, the more aggressive you are. I never go over a 1 beta because this is kind of like a risk management portfolio. So once I have all this figured out, this is for the central, the policy rate. The Fed's not going to move rates right now. They're not doing anything. What's their balance sheet doing? Well, they're definitely expanding their balance sheet. So they're easy. I mean, obviously, if I was to move this to tightening, you'll see that my beta would change. So, I mean, this is called the stochastic process, if anyone cares. Fiscal policy, they could put out some infrastructure bill and stuff. This is also pretty easy. So this is how I create, like, where do I want my assets to be and how much risk do I want to take on in the market? Once I've figured that out, then I can go into my security selection where I can pick which stocks I want to own. So given this environment, I have US equities, international equities, commodities, fixed income, and currencies. And I give each one of these a risk and a reward score. So over here on the x-axis, we have the risk score. And over here on the y-axis, we have the reward score. So right now, I want to own everything and right up in here, anything to the top left. So this right here, healthcare. Obviously, this is like a more defensive portfolio. We're in a more defensive environment. So this is a more defensive portfolio I want to create. Healthcare obviously is defensive. If you are sick, you need to go to a hospital. Doesn't matter what the economy is doing, you got to go to the hospital. So this is like healthcare, consumer staples. This is like Coke and Pepsi. This is your dividend aristocrats. This is your utilities, the most defensive sector out there. This is S&P 500 low volatility. So given this environment, these are the securities that I'm going to put in my portfolio. This is how I do security selection. And you can do it for commodities, international, like this is Denmark. I have that in my portfolio. This is fixed income. Obviously, I'm long like government treasuries relative to credit because credit spreads usually kind of widen in deflationary, inflationary environments. They don't do well when growth slows. So, I'm kind of a deflationary, portfolio at the current moment. So yeah, this is how I choose securities, and this is just another graph, but I don't have to get into that. But if you wanted to drill down, so let's say look, XLV. This is obviously recommending that I own healthcare. That should be like a 6% because I don't take more than a 6% position in equities. Healthcare should be one of my top positions, obviously. So I can come in here. This is my fundamental analysis, and I can come in here and I can find the healthcare sector. There it is right there. And these will all change. And it'll show me how it's done given all these different environments. So I'm not going to go through all of them, but you can see, in an inflation and deflationary environment, inflation, it's down -1, deflation, it's up about 8%. That's pretty good because most risk assets are both negative in an inflation or deflationary environment. So this tells me my expected return given the current environment. This tells me my percent positive ratios, how often this asset is positive. And I have all these different metrics that I can check for healthcare. However, my favorite tool is this one. If I come in here and I type in XLV, this is my quant tool, and this tells me a lot. This really helps me with knowing when to enter and exit positions. So it's going to tell me, what the current price is, what its 52-week range is, what its performance has been over 1 day relative to year to date in 1 year, what its relative performance has been to S&P 500, small caps, international, emerging markets, bonds, the dollar, what the volume looks like, what its correlations are to all these different assets, because correlations will change. So what its rolling correlations are to the S&P 500, to the bond market, to the US dollar, and obviously what its correlations look like relative to what's already in my portfolio. Given there's a lot of red here, it's not looking like a great portfolio diversifier. And that's because I'm already pretty defensively positioned. So that makes sense. I already own it, XLV, it's right here. It's at the top of my portfolio. But yeah, so that just is what it is. And these are my favorite quant metrics. This is the Hurst exponent. It tells me if a trend is intact or if a trend is reversing. Currently, right now, we have a pretty decently high Hurst exponent. It's at 56. If it gets to 60 to 70 and this price is moving up, I could get more aggressive with owning healthcare, maybe buy some more. I look at implied and realized volatility and make some decisions off that, and also the put call ratio of the specific asset. And that's really kind of all I have for you guys. This is one way that I construct a portfolio. You basically have your asset allocation. You decide what assets you want to own. You come in here, you select your securities. You throw your securities through different environments to see how they'll respond. And if you really want to dig down into US equities and you want to see how they'll perform in different environments. So say right now we're in deflation. The world's in inflation. The central bank is currently really easy, but let's say they tighten. Let's say they start to taper. What assets do I want to own if they start to taper? And these things will move. So I might want to start taking a position in consumer staples if I think the Fed's going to, taper and tighten their assets. Or if I think we get really surprised by something like Goldilocks, which could happen, you get kind of a bigger shift in some of the risk assets. This is the sweet spot. This is what you want to own over here. So I think I did that in a fairly good time, timely manner. That's one way. I know it was kind of fast. I hope it was interesting to you. I hope you know that all the things you're learning in school are applicable to my job. I use conditional probabilities. I use y equals mx plus b, and I use calculus literally every day. So yeah, that's all I have. Are there any other questions before we wrap up here?
And one thing before we do some questions, just for those of you here, just know that this Q&A is optional. You fulfill the requirements for today for the lesson plan and everything for today. So drop your questions in the chat, but it's optional now for the Q&A. So I guess I had one question really quick, but if you wanted to say something, go ahead.
No, I was just going to say I can take 10 or 15 more minutes for questions. If there's no questions, that's great. But if there are some questions, love to answer any questions.
Yeah, so I guess we have one question in the chat right now is, could you recommend what sources I can use to learn to construct this kind of model?
Yeah, 42 macro. That's what I use to help construct this kind of a model. It's the cheapest research. It's awesome. He's awesome. He's all about. I know this is a group of people who are less represented trying to get into finance, and he has an incredible story. His name's Darius Dale, and he was homeless for a while, and he just did not want that life. So he worked really hard, and he got into like an Ivy League school, went to Yale, and now he works as one of the best research providers on Wall Street. So he's an amazing story to me. I'm friends with him through Twitter, and I've been his client for 5 years. But I haven't seen him for a while. But he's coming to Chicago, I think, in October. So I look forward to meeting up with him. He's who I get a lot of my he does a lot of the legwork for me. I mean, I've built a lot of this stuff. I built this. I built this. I definitely built this. But he provides a lot of the data and does a lot of the legwork. So yeah, this is I got a lot of this from 42 Macro.
And I know you were talking a lot about like having a process earlier, and so it seems like is a lot of this just like on this like Excel sheet? Is it like coming just from building your process out and trying new things and like just creating these?
Yeah, it is. It takes, if you're like, hey, I need a process, what the heck? I mean, I've got a coworker who's 2 years older than me. He's still trying to figure out his process. I'm grateful to have found my process that works for me. Yeah, it's a little bit of trial and error. But once you hone in, I would say that have rules, and you can take my rules if you want. I've learned them from other hedge fund managers and stuff that abide by these rules. Equities, again, no more than 6% on your equities, no more than 4% on a commodity, no more than 10% on a bond. This is single positions, and no more than 12% on a currency. And that is done by volatility, because currency volatility is, other than like Turkey and Argentina, right? But like the US dollar and Swiss franc and Japanese yen, those things hardly move. So the less volatility that you have in the asset class, the bigger it can be in your portfolio. Does that make sense? So currency is like the lowest volatility in the market. So you can own up to 12% in currencies. Bond volatility is pretty low. You can own up to 10% in like a 10-year treasury. Equity obviously is a little more, and then commodity volatility can be pretty high. So I wouldn't take more than 4% in any commodity like wheat or corn, or I consider Bitcoin and Ethereum. I invest in them, but I don't take ever more than a 4% position in any of those. So I guess I'm saying, as you start to develop your process, at least abide by rules like that. You could, at least when you're starting your process, because you'll get it. You'll find your niche. I really like the quantitative macro. That's the area I put myself in. I love to do macro, quant macro. I think that's where the world's heading, is quant, and I really like macro. Macro does a really good job of, when things go haywire, of actually succeeding. I'm not much of a stock picker. I think that's fine if you want to be one. I just think the game's changed a little bit with passive flows and quants, and algorithms. It's not like it was in the 70s and 80s. I think you got to be a little more on your toes and risk managing your positions than just buying an undervalued stock. That's my opinion, but I'm sure a lot of people disagree with me.
So I don't see any more questions in the Q&A chat. If anybody has any more, please type them. Feel free to. We have about 20 more minutes if we need it. If not, we can go about wrapping this up. So I'll give a couple seconds, wait to see if there's any questions, and if not, we can kind of wrap this presentation up. All right, I think yeah, so thank you guys, everybody that was here, for attending the Street Smarts trading presentation with the Summer with Finance program. We appreciate you guys being here, and you guys are free to head out. I hope you guys all have a great night.
Okay, thanks for having me. I hope I was helpful to somebody.
Oh yeah, this was awesome.
Okay.
Thank you.
All right. Thank you, guys. Yep, we'll see you.